Hi friends, Daniellecheche here. Last time we touched on taxes, but I wanted to get a little bit more into that because I think it's such an important conversation. Again, please note that I am not a tax professional. If I'm wrong and you're a professional, please correct me in the comments. So unfortunately, you're required to pay taxes on your investment gains in the year you sell. Bullshit, right? Luckily, there are some ways to reduce your tax liability, and more importantly, it's all legal. You don't have to claim someone else's kid or something crazy like that. Butthole. First, you can offset capital gains with your losses, but the gains you offset can't total more than your losses. You can actually use up to $3,000 per year in excess losses to offset even your regular income, like your regular wages, interest, or self-employment income on your tax return. And then you can carry any remaining excess loss to the next year. Some people will intentionally take calculated losses to offset their gains. Be careful to avoid a wash sale though. Salem. Stop. Butto. Ham bone. Okay, so capital gains distributions and dividend distributions require investors to pay taxes in the year that they're distributed. Long-term investors may avoid or defer these taxes by holding their investments in a tax advantage account like a Roth IRA or a 401k. You can also buy and hold qualified small business stocks. It's a tax break by the IRS to incentivize people into investing in small businesses. If the stock qualifies under Section 1202, $10 million can be excluded from your income. So this is huge. Also, wouldn't it be so nice to make so much that $10 million can be excluded from your income? I actually got my start in real estate, and it's a really important discussion when it comes to limiting your tax liability. I may be biased, but there are a lot of government programs that you can use to minimize your tax liability. A great way to defer your taxes is to invest in a residential or commercial property in an opportunity zone. The definition for an opportunity zone on the IRS website is an economic tool that allows people to invest in distressed areas of the United States. It's supposed to create jobs and spur economic growth for lower income areas, as well as provide tax benefits to investors. I know this seems like it could be gentrification, and if done improperly, it could be. If you're doing this in your community, if you happen to live in an opportunity zone, you could do this to improve your community. So it helps to diversify your portfolio, and it is supposed to help the area because you're revitalizing it and making it nicer. Under the Opportunity Act, if you invest in an opportunity zone, you could defer your tax liability until December 31st, 2026, unless the property is sold beforehand. Along these same lines, you could use a 1031 exchange to defer your taxes, which allows you to sell a property and then reinvest in a like-kind property. And this is actually a more broad definition than you might think. It's not an apartment building for an apartment building. The regulation says that all real property is like-kind to all real property. So what does that mean? Basically, you can reinvest in any other kind of real estate. You don't have to reinvest in another apartment building. It could be a single family house that you're gonna rent, a duplex, a commercial building, really any kind of investment real estate. So then why does it say that? They just don't want people trying to exchange an apartment building for stocks or bonds or something. It has to be more real property or more real estate. You can actually do this as many times as you'd like, and you only pay taxes when you sell your final property, and you only pay the taxes for that property. Life hack, which really doesn't have anything to do with this, but I think it's important for people to know. If anything 4 units or under is considered residential property, which means that you could potentially use a residential loan to purchase a 4-plex, for example, live in one and rent out the other 3. So you could collect rent on those additional properties that you're renting out, offset some of your expenses. In addition, lenders tend to calculate a percentage of the possible rent that you could take in, so you could potentially, again, qualify for a bigger loan. All of this is obviously subject to your personal finances, and it won't work for everybody. All right, I'm just gonna talk over this leaf blower because it's not gonna stop. So, sorry. Yeah, that was just like a 4-minute real estate video. It's cool, whatever. Listen, I'm a spooky girl, so I love how morbid this next one is. You could always hold your investment until you die. You don't have to pay capital gains on something you never sell, right? Okay, but what about if you inherited a stock from someone? Will you have to pay capital gains when you cash out? Maybe not. You could claim a step-up cost basis, which basically means that even though the stock has increased in price since its purchase, you're starting with a clean slate as if you just purchased the stock at its current price, therefore negating any capital gains taxes. Okay, that's all I have for today. If you know of any other important ways to defer your taxes, please comment below and let me know. Otherwise, don't forget to drink your water and take your vitamins. Love you. Bye. you.